Is it more so margin management with the swaps being dated after the run? Why wouldn't there be a counterparty? The counterparty doesn't have to take on the risk of the price increasing. They can just be long volatility, right? Is that ordinary for normal working class retail traders have this sort of resolve that we have when dealing with the psychology of dealing with dips? No. Most people bail. They bail and then they buy back in when the price looks positive and lose profits. So futures FTD doesn't mean a big run anymore. I didn't say that. Futures FTDs could still mean a big run. But those don't come yet. Those aren't until the 25th. But if it is a big run, they need to keep the gamma exposure from this week off of that run, right? The things they're doing make sense relative to the position we think they're in. Because if they don't short us under the gamma exposure, right, under that window I showed earlier, this, if they don't keep us under this going into next week, and they do have lots of net short FTDs from the futures, then they're going to have a serious problem because they're going to have all that gamma exposure. On top of the FTDs that are due. So it is in their best interest to try to dodge as much of that exposure as they can. Now, don't get me wrong, they'll still have gamma exposure from the puts being settled. But it'll be less. See, they're the ones selling those calls. And they sell them naked, right? So they have no hedge, essentially. They're not a secured call. They're not like a covered call. They're just a naked call. And so to hedge a naked call, they would have to hedge appropriately. And since the stock is illiquid and they can't hedge appropriately, their best bet is to try to drive those calls out of the money. Then after those calls are closed, they don't care what happens, right?